Mickey Dickey here, and one of the questions I get all the time is in reference to life insurance. And as with most things, it's not as simple as everybody makes it out to be. Now, I'm going to run a couple videos here with Dave and just give you my opinion of this down the road.
Hey, welcome to the Ramsey Show. Hey, Thomas, Merry Christmas.
Merry Christmas to you too, Dave. Thank you so much. Hello, gentlemen. How you doing?
Great, man. What's up?
Nothing. Quick question. First of all, I just wanted to preface it by saying, Dave, I've been listening to your show for a while, and I really want to thank you for all your advice. I used to be one of those people that really just thought about, yeah, I can afford that payment. I can afford that payment, and just all of a sudden, I'm just under this massive amount of debt. And after listening to you for a couple months, I've just basically restructured the way I do everything. I'm just stopped buying stuff. I'm getting my debts paid off. Within a couple of years, I plan to be completely debt-free. So thank you very much for your...
Now, for those of you who think I don't like Dave, it's comments like this that what I want you to understand why I like Dave. He's helped out a lot of people over the years. Here's someone who's restructured, who's paying off his debt and getting things under control. And Dave has helped thousands and thousands of people with this. And I can't thank him enough for that. Which again, what I'm not trying to do is beat up Dave in my videos. What I'm trying to do is show that there are some inconsistencies and there's some other ways to do things. And I'll explain it here on the whole life in a minute, but let me just finish up this video.
Your advice. My question is, I've heard you talk a little bit about whole life policies. Now, my wife and I right now have whole life policies. They're good until we're 125 years old. We have about $1.5 million in coverage. Costs us about $680 a month to have that. And I've heard you say that you didn't think they were a great investment, but I haven't really heard you get into any details about why you think that is. So I was wondering if you could just talk about that a little bit, and maybe I'm missing something, and if I am, I'm sure.
Okay, I want to stop here. Now, first of all, I want to make this very clear. Life insurance, to me, is not an investment ever. It's a tool that can be used for financial planning. It is not an investment ever. And when the person says that he has a whole life policy good till he's 120 some odd years or whatever in the world he said, that is not necessarily accurate either. And you have to dig into the policies better than that because they're not as simple as saying I've got it till whenever. So please understand that there's a lot of issues with permanent insurance besides term. But let's finish this up.
You'll hit the point.
Okay, sure. The overarching main companies that sell whole life, the numbers break down about like this. Per $100 that you pay in premium, you can buy the same amount of term life insurance, 15-year level term, 20-year level term, for about $5.
Got it.
It's roughly 20x, okay? And for the insurance, obviously whole life, though, has another component to it that term does not have. You're obviously aware of that. You spend a lot of money on this. And that other component is a cash value buildup. Now, the cash value buildup is the other $95 out of $100 approximately. Could be $91, could be whatever, but it's somewhere in that range. Nationally, across the top 10 whole life insurance companies, it is $95. Okay, so $95 going into cash value, $5 purchases the same amount of insurance, life insurance. Now, so then the gripe that those of us have that hate whole life insurance, and it's not a mild dislike, I hate it, is that what happens to that $95? And in cash value, what you will do, and you're well past this, but if you went back and looked at your policy pages, your cash value buildup for the first 3 years, your savings buildup is zero. 100% of the $95 goes to fees. It's front-loaded as an investment, which in and of itself is not necessarily evil. It's just frowned upon in the financial planning world by and large. The second thing is that once you do start building it nationally, and again, I don't know your policy, but it's not going to be substantially different, the average rate of return on the $95, if you look at your actual cash value buildup, including the 3 years of zeros on the front end, it ends up being an average of about 1.2%. Let's be generous and say it's double that, 2.4%. Still not a good long-term investment. If I could get 2.4 on my money market, I'd be dancing a jig, but but not on my long-term investments. My long-term investments need to be north of 10% to be beating inflation and taxes. And so it's a horrible rate of return on a long-term investment. And those two things are bad, but the stake in the heart of whole life, and the reason the entire financial planning community that are not in the whole life insurance business have abandoned whole life. No one sells this but whole life insurance agents. No one sells it anymore. No traditional financial planner, no SmartVestor Pro, no one in the financial world sells it. The only people that sell it are whole life agents. They've gone away from it. And this is the reason. Once you've paid the extra $95 to build up, and on your $680 premium, you said you had a $1 million policy?
I've got $1 million. My wife has $500,000, and that's our combined premium is $680.
Okay,
yeah.
So $1.5 million. If you die, your wife, the beneficiary, I assume, would get $1 million. That's your face.
My daughter. It doesn't matter.
Okay.
But yes.
Yeah,
correct.
whoever the beneficiary is going to get the $1 million.
Right.
That's
Right.
what they're going to get. That's all.
Right.
If you have a cash value of $200,000 at 2.4%, that you put $95 per 100 in to get to $200,000 or to get to $100,000, none of that. So you have a savings account that for the first 3 years you put in there gives you nothing. After that, it pays 2.4%, and when you die, they keep your money.
Okay. And that's the part of this I really want to get to. And as much as he's beating this up, and rightfully, because again, if you have $1 million policy and you've been putting into it consistently and you have $100,000 worth of cash value and you die and they only get $1 million, what was the point? It doesn't matter what the interest rate is, it doesn't matter what the return is, you still only get the $1 million and it gets to your kids. Now, in this particular video, I'm only going to deal with the buy term invest the difference part. I'm having this on here because I want to make sure we're understanding why the term part is the important part in this particular scenario. Now, what I want to make sure we understand, one of the questions I get, and I've seen other videos on this, they beat Dave up because it's like, when they're 50 years old or they're 60 years old, they're not going to have a policy anymore. They're not going to have coverage anymore if they do term. Again, if you're 30 years old and you get a 20-year term policy or a 30-year term policy, when you turn 50 or 60 years old, you're not going to have any coverage. Again, if you're listening to Dave and you listen to most of us that get into the buy term invest the difference, the whole point of term insurance is to replace your income. And Dave's got some ideas on it. And the suggestion for me and for most of us in the industry is that you have 10 times your income. Now, some of us will go and say, okay, 10 times of net income. Some of us will go 10 times of normal income. And there have been times when I've got clients who are young and have a 2-year-old, and I'll say, okay, I would actually get coverage. Again, the 10 times then the question is, how long do you get it? So 10 times is generally the reason for that is that's 10 times your income. It should be enough to create an income stream for your spouse or whoever you're creating the income for to be able to recreate your income for a period. But I've got this financial calculator, and the reason I've got this up here is this. So let's just say you're 30 years old and you want to retire at 60, which is right after you're 59 and a half, so you can pull your money out of your IRA or your 401k at work. So what I'm suggesting and what he is suggesting is that you max out, you get a term policy for 10 times your income, whatever that is. If you're making $100,000 a year, it's $1 million, okay? And you put it on there for 30 years to get you to retirement. And the reason I suggest that is because if you're planning with your spouse to retire at 60 years old, which is normally my goal for my clients, you want to have everything ready at that point, okay? If you're done at 60 and you're going to start pulling money out and everything's ready to go, so why don't you need life insurance anymore? It's really quite simple. If you're investing the difference, which in this particular case is just taking $541 a month, and in the case the gentleman who was just talking about that $600 and some a month, all you're doing is you did a term policy. This is what you should be able to max out your Roth every year. So 360 months, which is 30 years. You put in $541 a month, and I'm using a 7% return, which all you do is you take 7 divided by 12, which comes up to the 0.5833. Your initial deposit's $541 because you're going to start maxing it out. Means that you've got $668,192. Now, that's a straight line number. I get it, okay? But I'm just saying on an average, if you put it into a Roth IRA and you just do the S&P 500, you're going to get most probably this type of return. But the point is that when you're 60 years old and you have $668,000 in your Roth 401k, why do you need a life insurance policy? Okay, for a death benefit, because that's the whole point. If you're 60 years old and you're planning it right, and you're doing things by what Dave is saying and what most of us try to do and try to plan ahead, or in whatever date this happens to be, whether it's age 60, 62, whenever you're doing your planning, the point is you shouldn't need 25, 50 grand or whatever to put yourself in the ground when you pass. You should have plenty of money sitting there for that. You shouldn't need a life insurance policy. Now, if you want one, that's a whole nother issue. But there shouldn't be a need for it. And this is the reason I've got the calculator. This is what he means by buying term and investing the difference. In his case, in mine, typically when I'm doing investing the difference, this is after tax dollars. You just put it in a Roth IRA and you max it out. Now, there's some other issues we'd have to deal with depending on what your income is and what you can put into, whether you can get it into a Roth or not, and then you might have to do it back to a Roth, and I've got other videos on that. But this doesn't seem complicated to me, and maybe I'm missing something that other people are seeing, I don't know. Because the biggest question I get from the whole life people is what happens if when you get to 50 and you've got cancer, or 60, you've got cancer, you're uninsurable. Again, you shouldn't need insurance at this point, folks. That's the point. If you've got the discipline to pay almost $700 a month like the other gentleman for the rest of your life, basically, you should have the discipline to be able to buy the term policy and invest the difference in a Roth IRA. And understanding this. So that's my opinion on the buy term, invest the difference. Again, there are other reasons for life insurance, and I don't want to go into them on this particular video. I'll bring it up on another one. So I want you to understand, in my opinion, life insurance is not an investment. It can be used as a tool for other things. So this video is just really buy term, invest the difference, and this is why. In this particular case, we've got a 30-year-old who for 30 years bought himself or herself $1 million life insurance policy or whatever it was to cover their income, 10 times their income for the next 30 years. And they invested, and all they did was max out a Roth on the other side of it. And when they got done and they made it to 60 years old, they've got almost $670,000 in their Roth IRA. If they pass, they just use the money out of the Roth to pay for the funeral. They're done. You don't need the policy. You shouldn't need this anymore. Now, here's the beauty. If you do need it, you can get other policies. And most policies today are convertible. So if you do have a situation where you get to age 58 or 59 and you need more insurance and you're uninsurable, you should be able to take your term policy and just roll it. It'll be a little more expensive, but you'll have guaranteed renewability at a certain age. So when you do get your term policy, make sure that it is guaranteed that you can renew. And most of the time that takes your health. It doesn't take your age, but it does take your health. So again, when you're 30, you're probably healthier and not as fat as I am and everything else, but you can, and as you get older, that becomes part of the problem as far as your premiums are concerned. But again, as you get closer to 60 years old, premiums aren't as much of an important part as being able to qualify. So again, in this particular scenario, all I'm saying is get your term policy, cover your income, invest the difference. Now, as far as using it for other tools and investments, we can talk about that down the road. And there are other reasons. Trust me, I'm not the person who says I beat up whole life and other types of permanent insurance, but they're for other factors. For what Dave is talking about, this works. It works great. There's other reasons for other types of insurance policies, and they work great for their intended purpose, in my opinion. So just my thoughts. Talk to your financial advisor. Make sure you've got what you need to get you to retire when you want to retire and how you want to retire. Dickie out.